Are you curious about why some stocks perform better than others? Well, the Fama-French 5-factor model might have some answers. Hello and welcome to our video on the Fama-French 5-factor model. In this video, we're going to take a closer look at this model and explain how it can be used to understand the cross-section of stock returns. Let's start with a quick background on the Fama-French 3-factor model, which was developed by Eugene Fama and Kenneth French in the 1990s. This model proposed that stock returns can be explained by three factors: the market, size, and value. Building on the three-factor model, Fama and French later developed the 5-factor model, which adds two additional factors: profitability and investment. This modification was made to further explain the cross-section of stock returns. So, let's take a closer look at these 5 factors. The first factor is the overall market, which is measured by the return of a market index such as the S&P 500. This factor captures the overall performance of the stock market and provides a benchmark for the performance of individual stocks. The second factor is the size of the company, which is measured by the market capitalization of the company. This factor captures the relative size of a company and its potential for growth. Small cap stocks, which are stocks of smaller companies, tend to have higher returns than large cap stocks, which are stocks of larger companies. The third factor is the value of the company, which is measured by the book-to-market ratio. This factor captures the relative value of a company based on its book value compared to its market value. Value stocks, which have a high book-to-market ratio, tend to have higher returns than growth stocks, which have a low book-to-market ratio. The fourth factor is the profitability of the company, which is measured by the return on assets. This factor captures the efficiency of a company in generating profits from its assets. Profitable companies tend to have higher returns than less profitable companies. And the fifth factor is the investment of the company, which is measured by the change in the book value of equity. This factor captures the level of investment a company makes in itself. Companies that invest more in themselves tend to have higher returns than companies that invest less. By understanding how these 5 factors can drive stock returns, researchers and analysts can gain a more comprehensive understanding of the stock market and how different stocks may perform based on their characteristics. Additionally, the model can be used to test the performance of investment strategies based on different factors, such as value or profitability. For example, an investment strategy that focuses on small-cap value stocks with high profitability and investment may have a higher potential for returns compared to a strategy that doesn't consider these factors. It's also important to note that the model is not a prediction of future performance, but rather a framework for understanding past performance and identifying patterns in the market. However, by understanding the factors that have historically driven stock returns, investors and analysts can make more informed decisions about which stocks to invest in and which strategies to use. So there you have it, an in-depth look at the Fama-French 5-factor model and how it can be used to understand the cross-section of stock returns. Remember, as always, it's important to conduct your own research and consult with a financial advisor before making any investment decisions. Thank you for watching.